How many participants generally attend for this? Is a paid course or free of course?
Free. It's a free.
Okay.
When it's for members, so yearly membership on their website. Around 200, 250 normally is attended.
Okay.
Okay, shall I start? Good evening, friends. Welcome to the second day of 3 days Fema series. Before we move ahead, let's rise for the motto of the ICI.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यपि कश्चन एतद्वैता
So once again, good evening, everybody. BCSE for the first time has organized 3 days series on Fema, and today is the second day, and I welcome all of you. For the today's topic, we have got two learned speakers, CA Rajesh Shah and CA Kirit Dedhia. CA Rajesh Shah will be covering FDI with respect to entry strategies in India, recent changes in FDI, policy downstream statements, pricing, etc. He will also cover up investment in LLP and Indian companies on repatriation, non-repatriation basis, including sectoral guidelines for real estate, startups, etc., and many other issues. He will also take up few case studies. So first session we'll be having from 5 to 7, and thereafter we'll have a break of 5 minutes. Thereafter, CA Kirit Dedhia will take acquisition of immovable properties in India by foreign nationals and other entities. Before I request Shreyansh to introduce both the speaker formally, I'll just remind you that third day of this series will be on 29th of May. So you are requested to join for the same also. I request Shreyansh to introduce Rajesh Bhai and then Kirit Bhai.
Yes, thank you, Sharat sir. Good evening, members. So first I'll introduce Mr. Rajesh Shah. He's a practicing chartered accountant and a law graduate. He's a partner of Jayantilal Thakkar and Company, a chartered accountant firm specializing in international tax and Fema matters. Practicing over 20 years as a consultant to various industrial and service organizations in diverse business segments. His broad service areas are as follows: foreign collaborations, joint ventures, franchising, strategic alliances, non-resident investment, international tax structuring and tax management, strategic business and corporate planning, tax and corporate loss planning, legal advisory and consultancy services, legal documentation, legal matters, appealing before RBI for compounding matters. His professional contributions are as follows: he was a chairman of International Taxation Committee of Chamber of Tax Consultants and convener of Fema Study Circle at BCAS. He has co-authored book on Fema and its procedures and also contributed to books on international taxation. He is a committee member of various study circles and contributes on Fema and international taxation at various forums. He has made presentations on various subjects pertaining to NRI compounding matters, international taxation matters, foreign investments, inbound, outbound, joint ventures at various conferences and study circles at BCAS and Chamber of Tax Consultants. Now we would like to present a memento to him.
Rajesh bhai, this is a virtual memento.
Accepted.
So and Borivali Studies CP Circle, the Borivali Central CP Study Circle will contribute 500 to CABF on his behalf.
Thank you.
Now I would introduce CA Kirit Dedhia. He is a chartered accountant in practice for over 25 years. He is a founding convener of the Daisa CP Study Circle. He has co-authored a book on Fema published by IC in 2005. He is a vice chairman of International Taxation Committee of the Chamber of Tax Consultants. He is also a member of International Taxation Committee of BCAS for past 15 years. Now I would like to present a memento to him.
Thank you.
Shreyans, it's not coming.
Yeah, once. Right. And Borivali Central CP Study Circle will contribute 500 to CAPF on his behalf.
Thank you, Shreyans.
Yeah. So now, now I would like CA Rajesh Shah to commence the session.
So Sharad bhai, my screen is visible?
Yeah.
Perfect. Good afternoon, everybody. Glad to see that we have so many participants at this time. When I accepted this talk, there was a chances that it would clash with the IPL. Hence, I was worried whether we will get the audience or not. But thanks, I think some institute has said to BCCI that this is more important and IPL is stopped for the time being. It's postponed. And if you see the kind words, yes, Sharad bhai?
At present, 245 participants are already there.
Yes, I could see 245 participants. That is the reason it is always like homecoming to this Borivali Central CP Study Circle, because here the people are more interested to learn whether it is Saturday evening. Thanks to Shreyans bhai for the kind words. If you see the introduction, I am a little junior to Kirit bhai, so he's kind enough to give me a little more time. He has 25 years of practice to mine of 20 years. So the topic which is given to us, big entries, strategies and all, I have synced this totally into foreign direct investment, because I always try to keep my topic as simple as possible. Same way, the session which will go for 2 hours, 120 minutes. At the time when it was non-virtual, it was more interactive, but we'll try to keep more interactive by way of Q&A. As the organizer says, we will try to keep a 50 minutes of mind session and then 10-15 minutes of Q&A, Sharad bhai, with your permission. And then we'll again go with this 40-45 minutes and then Q&A again.
Perfectly. Right.
Okay. So friends, when the topic is being given to me, this is a dear topic, because this is the time when in the last several years, what we are seeing is the foreign investment is coming to India, and it is coming into the various modes. One of the mode is foreign direct investment. Second mode is foreign direct investment on a non-repatriable basis. The first is a repatriable basis. And the third is the investment in LLP. These are the 3 schedules which has been assigned to me. So I'll try to cover in detail all the 3 schedules. Time permit, we'll go to other schedules, or Then we will see how we take it forward on the Q&A basis. Since the second speaker will be speaking on an immovable property, we don't want to breach on his time, so we'll try to cover in the time allotted to us. So with the number of audience and what we spoke to the coordinator, we'll try to start with the initial phase and then take it to a higher level, so it becomes interesting for everybody to understand what all this about. Now, when we are talking foreign direct investment, let me tell you, Fema was introduced in 1999-2000. At the time of 2000, all this thing was handled by Reserve Bank of India. In 1999, they came out with the NDI rules 2019. There was a budget amendment which said, okay, now all this foreign direct investment will be controlled by the central government, and RBI will not issue any such circular on this impact, and everything will be handled by central government. Hence, what we need to keep in mind is, now onwards, FDI policy is issued by the central government, NDI rules is issued by the central government, and all those things will be taken care by the central government. Now, there are issues which has cropped in. There is an FDI policy, and then there is an NDI rules, which are both issued by the central government, but the different ministry. And between the two, if there is any conflict, what we have been seeing in the past also, which will be more final authority. So it is mentioned, in case of any inconsistency or conflict between the FDI and the NDI rules, the NDI rules provisions will be more prevailing than the FDI policy. Now, what we say is NDI rules, FDI policy, and what we see, everything is available on the government website. Just keep on downloading new things which comes in. One of the thing is the e-commerce, where there is some difference of definitions which are there. So what I need to make you understand is, we have to keep NDI rules which came in 2019 to be more precise what we need to understand. Again, after NDI rules, there is a FDI policy of 2020 which came in. Again, there is an issue relating to this e-commerce entities and all. Why we are concentrating on e-commerce entity? Because there is most action happening, more investment coming in. We had a case of Flipkart being taken over by a foreign company, by some structures and by some investment. So all these things we have to keep in mind. So when we are looking, a question was asked, why I am concentrating more on this FDI, NDI rules is, if there is a conflict, now we understand it has to go through the NDI rules. But then why FDI policy and NDI rules both has to be in line with each other? Reason being, one is issued by the one department and the another is issued by the another department. Finance Ministry takes care of the NDI rules. Hence, it is more important. Now, what we need to keep in mind is, what are considered as an FDI, what is considered as an FPI, what is considered as earlier FDI, now FPI. So these are all important things what we need to keep in mind. Now, when we are talking about foreign direct investment, when I'm receiving the investment in an unlisted company, a private company or a public company, then it is always an FDI. So 90% of the professionals who are talking right now with each other, we are all dealing with the private companies. So in a private company, it's whether investment is coming less than 10%, more than 10%, equivalent to 10% from outside India, it is always to be considered as a foreign direct investment. However, if the investment is coming in the listed company, up to 10%, it is considered as an FPI. But if it is more than 10%, it is considered as an FDI. So as it mentioned, FDI in listed company of 10% and more will always be considered as an FDI. FDI more than 10%, and if it is falling less than 10% at a later stage, will always remain as an FDI. But If foreign investment by a person resident outside India is below 10%, then it is considered as a foreign portfolio investment, FPI. FPI we will not be discussing it today because it falls in Schedule 2 and Schedule 3. Hence, we will be concentrating on Schedule 1, Schedule 4. Why it is important is because this is the fundamental base which is being created when we give advice to our clients as to whether it will be FDI, FPI, certain forms to be submitted. So if it is FPI, the forms are not required to be submitted. So all this care what we need to see. Now, when I say with the FPI, only SEBI registered FPIs are allowed. Hence, what we need to keep in mind is A, foreign direct investment in unlisted company, always an FDI. Whereas only in the listed company, we need to keep all these things in mind. Okay. When we are talking about FPI, there are certain regulations where the SEBI regulations apply. When we are talking about the FDI, certain guidelines are applicable more in FDI than the FPI. So since we are discussing all about FDI, we need to keep in mind that all guidelines do apply for the FDI. Hence, definition of FPI, less than 10%, always an FPI. Receive more than 10%, FDI. All these are the background fundamental when we are talking about differentiating between the FPI and FDI. So let us get into the same thing. This chart is the most important chart what we need to keep in mind. We've already discussed FI in unlisted, always an FDI, percentage is irrelevant. More than 10%, it is FDI. This is what we discussed. Now, these are certain COVID takeovers. What has come in the last year is also very important because when we look to the FDI guidelines, there may be certain areas where we feel that the investment is permissible. But when we talk about the certain areas, even though it is permissible under the normal guideline, there is a circular press note which has come in, which prohibits such investment under FDI category. So let us see what it was. Any investment, because as per the general policy, I cannot point out to a particular country. Very wisely, the government of India came up with the theory that any country with I am sharing the land boundary, you are not allowed to invest into India on an automatic route. Of course, the approval route is available. Even after April 2020, the classic case of one Dream 11 company where there was a receipt of money from the company or the investor which is based in the neighboring country on the approval route, it has been allowed. So what they have done is they have controlled the money which has to come to India in Indian company on the activities based so that government controls what should be allowed and what should not be allowed. Now, the one more reason what we saw was HDFC Bank. There was one trigger point wherein the Chinese company has taken over more than 1% in the current bank because it was available cheap. Share market was at all-time low. We tried to control this by this particular regulation. Now, whether this applies to the old or new investment, let me tell you, it applies only to the new investment. It doesn't apply to the old investment. Whatever has come old is absolutely fine. But if there is an old investment and if there is a right issue, then yes, it falls under the new investment and it will be required. Hong Kong, although we call it as a separate country, it is at par with the China. So any investment which is coming from China or from any Hong Kong based investor, it will fall under the approval route. Now, we have a classic case whereby the investment is coming from a Netherlands company whose shareholders are based in UK, who earlier held the Chinese passport. Now they are not holding the Chinese passport, they are holding the UK passport, and the investment to India is coming through a Netherlands company. we said, as an abundant precaution, it is important to get the approval of the central government, because the investment which was coming was more than 100 crore, and the Indian partner felt it is important not to be on the gray area, get a clear-cut approval and get the investment. Although the investment was of utmost importance, because from the last 1 year there was all the due diligence and all other paperwork which was being exchanged, shared and all, but the client felt, and the client was right, because they are having some of the other connection with the Chinese country, they felt, central government approval will be required. Now there are cases where PE fund is investing into India and there are Chinese investors in those PE fund. Again, everywhere, wherever there is a Chinese source or something was there, restriction would apply. And if they are not taking the approval, then all other guidelines which requires application, requires approval, and if not taken, can have those effects. So this was the little bit of background before we get into the main subject of foreign direct investment, entry strategies, and whatever way we call it for the real estate, startups and all. Let us go one by one. As I said in the initial, you as an audience are free to start posing the question. I'll be taking all together, but make sure these questions are relating to today's topic and not the case for opinion. Time permit, we'll try to cover all those things without breaching into Kirit Bhai's time. So when we are talking about foreign direct investment, we need to understand the concept which is person resident outside India. A person resident outside India can be any person who is outside India. He may be an NRI also, but there are certain benefits available to NRI. They can be an OCI card holder also. NRI person, I think Manoj Bhai must have covered yesterday. NRI person are those holding Indian passport but settled abroad. OCI cards are those people who surrender their Indian passport, taken the overseas citizenship, and now they have applied for the OCI card. And they are also at par with the NRI for various purposes. Now, what we need to keep in mind is when the foreign direct investment is coming into India, we as a professional who is guiding the client has to keep it in mind that which sector the investment is coming into. If the investment is in the approval route, then you cannot go under the automatic route. And there are certain investments which are under the approval route, fine, but there are certain sectors which are under the prohibited category. So if it is under the prohibited category, then FDI cannot come in. So we had a classic case of tobacco company who was to receive the foreign direct investment. Tobacco fall under the prohibited category. So you cannot take foreign direct investment into this thing. Right now, whatever I am discussing is under Schedule 1, which is on a repatriable basis. If it is on a non-repatriable basis, that prohibition category comes down to only 3 to 4 items, which we'll see separately. So when we are talking about in the first 10-15 slides is all about the repatriation Schedule 1. Okay. So what we all as a consultant, as an advisor need to keep in mind. One, whether it is in the prohibited category. Two, the main category may not be prohibited, but the client who is carrying out the activity in future may not be permitted. So when I'm doing the audit also, at the initial stage, FDI has come 3 years before. I have a company with a foreign investment into India. Hence, FDI is allowed, forms are submitted. But when it comes to a new round of new section or new vertical which is being started, if that is prohibited, then you cannot carry out this activity in this company. Examples is IPL teams which are having some or the other form of foreign investment into India. When they started this online merchandising, marketing the product of selling their t-shirts, bands and all, when it was B2C, it is prohibited because foreign direct investment, there are allow only on the single brand retail up to a particular percentage and all those things. But direct retail is not permissible. Under the sports category, FDI is permissible, but when you same company carries out such activities, it is prohibited. So we as an auditor of the company, when we are advising the company, all these things needs to be taken care of. Foreign direct investment, we have seen the activities. We have seen now the land countries sharing the land border. It is prohibited under the automatic route. Even in the future transfers and all, we also this need to keep that in mind. Now, what are the categories which is prohibited? FDI is prohibited in this lottery business, gambling, betting, casino. A question was raised when we see this various other product which we see on the marketing relating to the cricket, whether it is considered as a betting or whether it is considered as a gambling. The clarification which came is no, these are not providing any betting or gambling because it cannot be encashed. And what is this whole, this is a platform driven chances of winning, and it is not being considered as a betting as per the latest guideline of the government. Chit fund, Nidhi fund is all falling under the prohibited category. Now, TDR is another thing where there is a prohibition. So what we need to keep it in mind is real estate activities permissible. You can bring FDI. Various companies we are seeing in the real estate are getting the foreign investments into India. Absolutely fine, allowed. There is no restriction. But what we need to keep it in mind is it cannot be, the Indian company cannot be carrying on the real estate business, which means buying and selling of land, trading in TDRs. So here, if you see the definition of real estate business, which has been mentioned, it says real estate business or construction of farmhouse. But real estate business shall not include development of township, construction of residential and commercial premises, road, bridges. Now the definition is further improvised and said real estate business also doesn't mean giving the property on lease. Hence, what we need to keep in mind is every activity as a developer, builder is permissible. What is not permissible is the real estate business, buying and selling of land. And the most important thing, construction of farmhouse is also prohibited. Construction of farmhouse, if you have a client who says, okay, now let me start certain activities of second homes in Karjat, Lonavala, Pauna, and if those are relating to the farmhouses, then it is prohibited. You cannot have a foreign direct investment into these Indian companies. Now, again, as I said, at the cost of repetition, all what I'm talking is about is the Schedule 1 investment. Similarly, FDI is prohibited if the manufacturing of cigars, sheet roots, and all those tobacco-related things, atomic energy, railway operations, foreign technology, lottery business. So all these things, when we are talking about, when we advise our client, make sure that they do not fall under the prohibition category, because if it is under the prohibition category, FDI is not allowed per se. So there is no chance of any compounding or anything happening at a later stage. If it is under the approval route and you brought it under the automatic route, then the chances are you can go in compounding, get the post facto approval and regularize the thing. But when it comes to prohibited categories, RBI will not give you, central government will not give you permission, and RBI will not take it on record, and they will ask us to unwind the transaction. Now let us come to the various other aspects. Whether we are talking about the fresh issue, whether we are talking about the private placement, and when we are talking about the right issues. So when it comes to the fresh issue, let us concentrate on FDI into a private companies, because under the FDI to the listed company, SEBI rules, regulations are applicable, and pricing norms as per the listing, everything is applicable. When we are talking about FDI in a private company, public company, which is not listed, then what we need to take care is whether it is a fresh issue, private placement, in both the cases, the valuation guidelines come into the play. When it is a right issue to the non-resident, if the right issue is to non-resident as well as the Indian resident, then the pricing guidelines doesn't apply. The NDI rule says at the price at what it is being offered to a resident investor and if the same price is being offered to a non-resident investor, then they are okay with it. Now, certain places where companies can issue shares in lieu of dividend payable to the promoters. These are all the technical aspect where we will come to know only at a later stage, because at the initial stage, when foreign investment, when we talk about the strategies, all what we see is there is a foreign investment which is coming into India. They bring in the money into the Indian company, and the company is a FDI compliant. Money is on a repatriable basis, and we are good to take off from here. Now, when we talk about the schedule to investment, just as a passing, we need to see that FPI is allowed up to 10% and up to 24% in all FPI together. When we talk about Schedule 3, it is NRI, OCI who are coming on a repatriation basis, but through the different model and not through the Schedule 1. Now let us come back to the Schedule 1. What are the type of instruments what we can issue? For the instruments, what we need to keep in mind is all they are allowed to issue is CCD, equity shares, CCPS, and share warrants. Equity shares can be partly paid, but it has to be an equity shares. CCDs are permissible. The CCD has a convertible time up to 5 years, 10 years, which can be further extended depending upon the mutual consent. And CCPS can go up to the 20 years. Yes, but they are compulsory as it is mentioned over here, and not optionally convertible, or it cannot be redeemed without conversion. So the Indian company which are bringing foreign direct investment has to keep it in mind that if I am looking as a foreign direct investment, I can issue only equity, CCD, CCPS or the share warrants. But if they are looking to issue foreign FCCB, whether we call it as in ZOCDs, whether it call it OPCS, all those things then will fall under the ECB guidelines and not over here. Now, what all aspect we need to keep in mind? Valuation, issue of shares. So when we are talking about issue of shares, if a foreign company is investing into an Indian company and making it as a subsidiary, or any foreign investor in an individual capacity who wants to invest into India, then for the initial subscription shares, the valuation guidelines do not apply. It can be issued at the par. There is a clarification to this effect, which clarified various concerns of various chartered accountants who were of the dilemma what price we can issue the certificates. Of course, now when I'm mentioning that the chartered accountant can issue the certificates, this is under the Fema guidelines. If under the Companies Act, only the registered valuer chartered accountant can issue the certificate, then those guidelines will apply from the ROC point of view. We are here only talking under the Fema point of view. So keeping this in mind, we need to see when we are talking about the allotment of shares, initial subscription, no guidelines apply. It can be at par. When we are talking about further allotment of shares, Fema earlier had a DCF method. Earlier, prior to 1997, prior to 2007, there were other guidelines followed. Now, what they say is any internationally accepted method is permissible. So RBI has kept it very open. Anybody can issue at any price, but comply with the guidelines where it can be any international method. NAV, discounted price, multiple X of the turnover. So whatever is acceptable is fine with it. But what we need to arrive at, any method which is followed, if the price is being determined, you cannot issue shares at a lesser than that value. When we are talking about listed companies, as I said, SEBI guidelines will apply. They go 6-month high-low, they go 15 days high-low, average of the two, and they come out with the guidelines as to what pricing they can be issued. Make sure that there is no assured return. There are certain formulas which has been brought into the NDI rules, but to try to keep it as vanilla, plain as possible, so that it is very crystal clear when the money is coming in, there are no reading between the line. The shareholder agreement should be as plain as possible, so that the method is being prescribed and the price or the shares at which it is being issued clarifies everything. In my CCD, in my CCPS, I have to upfront mention at what price I'll be converting into the equity shares. Yes, there are certain milestones what we see in the various shareholders agreement. At this particular milestone, if they perform, this will be converted, but their days has to be covered. I mean to say, let's say if the CCDs are issued and the conversion ratio is 1:1, or let's say 1:2. So for every one equity shares, for one every CCD, two equity shares will be issued. That is fine. You can issue 1:1 after that, and after 4 years, 5 years, but you cannot issue 1:3. So the base is clear, so that RBI know at any point of time, this many shares will be issued to the foreign investor. It can be lesser than that, but it cannot be more than that. Hence, what we have been to keep in mind is value at what it will be issued. Of course, we are not getting into the 11 UA, we are not getting into the 56 to 10. These are definitely, we have to keep in mind those regulations also. But right now, we will restrict our session to Fema only. Now, when we are talking about the other than the equity shares, other than the equity shares are CCD, CCPS, what we have discussed. CCD, CCPS are considered at par with equity. When we are talking about redeemable preference shares, optionally convertible preference shares, optionally convertible debentures, partially convertible debentures, all those things fall in the ECB guidelines, and it has nothing under the FDI. Now, a question was asked, can it be at a particular percentage and all? Yes, CCDs, CCPS can be at a coupon rate which is up to 12-13%. We have seen there is no restriction as such. RBI has accepted it. And only thing what we need to do is we have to give a issue price formula at the time of issue of shares. We will come across the forms portal where the forms has to be filled in. We will see if the conversion ratio has to be mentioned at the issue date. Yes, the partly paid shares are allowed, but what we need to keep in mind is when an Indian company are issuing partly paid shares, then the 25% is upfront and the balance has to be brought in within the period of 25 months. If not, then the 25% will be forfeited. Earlier, the TISPRO was, there was a monitoring agency where the investment value was more than 500 crore, but now this agency is removed under the NDI rules. TISPRO rules, what we say is transfer of securities by a person resident outside India. Now it is, TISPRO was issued by Reserve Bank of India. Now NDI rules is issued by the central government. Almost everything remains the same. This is only we need to keep in mind. Now the convertible notes. Since we are touching upon the startup companies only, also we need to keep in mind that convertible notes are very famous in the startup companies. So it can be issued only by the startup companies. Now startup companies are those startup companies, NDI rules define those startup companies. So wherever the company has got the certificate that it is a startup company, then only the convertible notes can be issued. Now, what are the conditions attached to the convertible notes? Convertible notes are initially the debt, but these are treated at par with equity for the startup companies. They are convertible at the holder's option. So this is only to bring at par my country with the other foreign countries, where the foreign investors who wants to bring in the form of convertible notes, the convertible notes holder on the basis of the performance can decide whether he wants to convert it or he doesn't want to convert it. So maximum years for the conversion option is the 5 years, 25 lakhs or more, it has to come in a single tranche. If there is a government route, depending upon the activity what the Indian, then you have to take the prior approval. Equity shares can be issued against the convertible notes as per whatever the pricing guidelines and all those things apply. So share warrants can be issued by every private limited company, but this convertible notes is only by the startups. Now, when we are talking about the pricing guidelines has become very simple. It has to be any internationally accepted method issued by a certificate, by a chartered accountant, SEBI registered merchant banker, or it can be cost accountant for unlisted companies. This is, again, I am repeating, only under the Fema for the submission of certificate uploading at the firm's portal. Under the ROC, you have to comply with the ROC guidelines. Now, what we need to keep in mind is when I'm issuing the share warrants are again the same. The formula has to be determined upfront. Now, identically, when there is a swap of equity, so if I'm issuing shares to a foreign company in lieu of the investment they are holding into an Indian company, then in such scenario, you will require merchant banker and chartered accountant will not be applicable in this case. Now, as I said, this explanation pricing guidelines apply all when we are talking about the Schedule 1 investment. When it is a Schedule 4 investment, pricing guidelines do not apply and it can be issued taking care of the Indian law point of view. Now, when we are talking about the principles of all this pricing at the time of investment, at the time of exit, make sure that you comply with this pricing guidelines, because if you are not complying with this, then Reserve Bank of India comes heavily. So we had a case of the shares was valued at 142 rupees, and for the sake of convenience, they remitted the money only at 140 rupees. So it was not allowed, and they said you will have to bring the balance 2 rupees back to India. And again, come by way of filing of the forms and of course the compounding and all. Now, in the pricing guidelines also, when you are converting CCD into the equity, it can be performance based, but it cannot be guaranteed. There cannot be assured return. Classic case of the Tata Docomo, it reached up to the various court level, and then ultimately it was not allowed as an assured guarantee, but it was remitted as in damages and all. There is a thin line of difference between the assured guarantee and the damages. But since the company involved was Tata, they were being given the permission, and then only the remittance took place for these damages and all. But many times we have seen at the time of issuing the shares FCGPR, if it is linked to any assured return and all, they are not issuing the and not taking on record. Now, we have been talking about the FDI on the automatic route. Now let us go to the approval route. Certain sectors where you require the prior approval. Now let me tell you friends, wherever this DIPP is mentioned, let us read as FIFP. Now FIFP is the agency who accept all your applications and run through all these things. So let me tell you, when I'm talking about the approval route, anything which is not matching with the automatic route, they are also covered in the approval route. There are certain sectors, defense, aviation, telecom. Now the aviation to a certain extent on foreign NRI has been allowed on an automatic route. But what we need to keep in mind is anything which doesn't fall under the automatic, sector sensitive, certain activities which are very sensitive in nature from the country perspective, all these things needs to go under the approval route. You want to issue at a price which is less than that, again it will go under the FIFP route. All central government approvals come through a single portal. There is a separate procedure. You have to, the U means the Indian company over here who is going to receive the investment has to apply on the portal, register the company, and they can go ahead with uploading all the forms, the details about the foreign investment, why it falls under the approval route, make the application. In today's time, it is taking more than 6 months to 9 months. Earlier, it was 4 months to 6 months. We used to get things. Same thing is with the NBFCs, automatic route, certain things doesn't fall under the automatic route. So what we need to keep in mind is what we fall under the automatic route. You have a straight away FCGPR which can be filed. When we are talking about the non-automatic route, you come through the FIFP. Again, all these financial services, multi-brand retailing up to a certain percentage is under the automatic route, certain percentage is under the approval route. So what we need to keep in mind is whenever we are talking about the guidelines, sector, capitalization, we need to see what is the latest rule, because this is the most active areas where there is a movement of all the activities which are taking place. So we need to keep in mind as to what all activities fall under the approval route and what are the criteria which we need to while making the application. When we are talking about the retail trading, now retail trading, e-commerce is a separate, retail trading is a separate. E-commerce on a platform base is separate, or a inventory based model is separate. So when we are giving the advice to a client, we need to see the existing guidelines as to whether this case will fall under the automatic route or the approval route. FDI in e-commerce on a platform which is the inventory model, you require approval. Number two, when it is B2B, you don't require any approval. B2B is under the automatic route. When we are talking about the wholesale trading, it is under the automatic route. When we are talking about the cash and carry, it is under the automatic route. 100% FDI is available on the automatic route. But then there are certain guidelines in the wholesale category where one group companies cannot sell more than 25% to another group companies. So all these things we need to keep in mind. So these were all the theoretical part relating to the schedule 1. Before going to the practical part, I think it's a time to take up the Q&A. Then I will go to the practical part. Over to you, the coordinators. How you feel? You want me to take it? Whether it will be in the Q&A or there is something will be shared, please do tell me. Sharad bhai?
Sorry.
Sharad bhai, how you want me to take?
There are some few questions are there.
Okay.
If you want, we can take up those questions.
So it is in the Q&A section?
Q&A, yeah.
Chat?
You can Q&A.
Okay, fine.
Can you go through it or shall I?
Yeah, no. Fine, I can go through it. Whether FDI is permitted in listed companies whose activities are of online gambling and casino. If it is an online gambling and casino, it falls under the prohibited category, Vipul bhai. Hence, it is not permissible. What is permissible, what we are seeing is only on those cricket matches, making teams and all, they are saying we are only providing the platform. It is nothing relating to online gambling or casino. It has no action of yours. It is the action of the others, which is being a bifurcating source. Whether real estate business covers giving commercial premises on rent, yes, Bharat bhai, the definition has been changed. Now the real estate business specifically excludes giving premises on rent on the live-in license. Hence, it will not be treated as a real estate business. Can an NRI holding PIO card set up an educational institution in India with his foreign funds by forming an NGO or the trust? So Neeraj, NRI holding the PIO card, now he has to take up the OCI card because otherwise he will be treated as a foreign citizen. He can set up an educational institution which is permissible. Now, when he wants to bring the foreign fund, he will require the FACRA approval and not the Fema. Fema doesn't come into the existence for such things. Educational institution, when we are referring it to the Section 8 companies cannot have foreign investment. what will have to be done is a trust will have to be created to carry out this educational activity, and for the infrastructure cost or for whatever other thing, that trust will have to bring in the FACRA approval through this, and it can be done. I hope I'm clear. Can CCDs be transferred to a third party during its tenure? The answer is yes. If you see the FCTRS form, now it has been specifically made allowed that CCDs are convertible, transferable till it is not converted. So there is way we can structure whereby government is concerned with the FDI. So when the CCD was issued, FDI has come into India, and now when the CCD has to be CCDs are to be transferred to the third party, it can be done without any approval. NRI, OCI partners, capital can I take LLP a little later, because I have already covered all these things. Are Forex brokers allowed in India? Allowed? My answer is no. Forex brokers fall in the NBFC categories, and they will require certain licenses and approvals on an approval route. Only once they are on the approval route, they will be allowed. But let me tell you, various FFMCs which are there in India, which has this Forex broking license, which we call it as an FFMC, then they come as an Indian subsidiary, they comply with all the guidelines which is applicable as an NBFC, and then they apply for the foreign license of FFMC, and the permission is granted by the Reserve Bank of India. Like Autofx, which are having advertisement in YouTube to trade in FX currency. Now, when you're talking about the cross currency pairs, YouTube, chances are they are not on the Indian platform. We had a classic case of last week when there was a turmoil on the crypto and the people are trading in this. What we need to keep in mind is whether they are permissible, not permissible. It all depends upon whether they are on the Indian platform or not. Hence, when we are advising, what we need to advise is which is prima facie permissible, you can go ahead. Which is not prima facie permissible, get all the documents before giving an opinion whether it is approved or not. According to me, Octafx and all, you as an Indian individual cannot trade on the derivatives or the foreign currency, so it is out of question. Indian companies has FDI of less than 5%. Can it conduct the business of BTOC? What is this BTOC, which is not the inventory model? Mr. Jay Prakash, can you just throw some light on BTOC model?
I request Mr. Tiwari. Yeah, Mr. Tiwari, if you can put your little elaborately in your Q&A, then Rajesh will be able to give answer. Meantime, Rajesh, you can proceed with the next question.
Okay, B2C, he has mentioned. Okay. Okay, fine. So when we are talking about B2C, Indian companies having less than 5% also, if they are in the single brand as a specific guidelines within which you can carry out the activity. But if it is a multi-brand, it doesn't fall under the automatic route, because where it is not on inventory model, then if it is on the platform, which is only pure the technology driven, then you are allowed. Let me tell you very clearly, because RBI has bifurcated between the inventory model and the non-inventory model. I think Sharad bhai, I've cleared all the questions raised till now.
Yeah. I
Okay,
think all
fine.
questions are covered.
Perfect. So let us go back to the
correct. Next.
Yeah.
Next topic.
Okay. Now, friends, this is a case of a multi-brand retail trading case study whereby there is a company one, which is company in one, and there is a company two. Company one and company two is holding 62 and 38% in company A, which is into the multi-brand retail activity at company C level. So when we will be discussing about the downstream investment, we'll be talking about the foreign-owned Indian companies. What we need to keep in mind is, if this foreign company, this company one has 62% in A and company two, 38. If that Indian company one has a foreign investment less than 49% and they are carrying on the activity which is permissible under the FDI rule, then it will be treated as an Indian company, and that company 1 investing into company A vis-a-vis company 238, it will be considered as an investment by the Indian company per se, and they carrying out the multi-brand retail, then it will be treated as an Indian company who is carrying out this multi-brand retail and not the foreign companies. This was the exact case of, in this case study, company C, what I'm referring to as a multi-brand retail outlets is 575 supermarket stores and all. Supermarket stores cannot have a foreign investment into India. So what they did is, the company A is owned by 2 private companies of the same group. The company A, what I'm referring to, is owned by 2 Indian company again, which is company 1 and company 2. So now, if a foreign company wants to acquire company C, can foreign company acquire foreign C? So this is how it was carried out. So the investment came at the upper level, which was diluted as a foreign investment into India, an Indian company, and then Indian company further making investment into another Indian company. So now, what we need to keep in mind about this downstream investment, this was just a give you a food for thought how the people are carrying out these activities. So when we are talking about foreign investor, they directly invest into an Indian company, and that Indian company invests into a second Indian company, then it is treated as a direct FDI. Now, there are chances of indirect FDI coming into also. So how does the indirect FDI come in? Indirect FDI comes through the, again, Indian company only. Now, any Indian company which is carrying out the activities which is permissible to receive foreign direct investment into India, if that foreign direct investment coming into company A is less than 50%, then it is treated as a owned and controlled by the resident Indian. It is not considered as a foreign in company. Hence, those are not counted as an FDI when they make a downstream investment into India. However, if an Indian company which is owned or controlled by a non-resident and that company invests further into India, that is treated as a downstream investment. So we need to see at what level the investment is coming into and what level the investment, which company is investing into. We will be discussing on the various forms to be filed even at the downstream investment level. So a foreign company can target the Indian company which is carrying on the routine FDI activities, which is FDI compliant. They bring in less than 45%, 49%. That company will be treated as a foreign investment, but Indian-owned Indian company, which can further invest into a downstream investment. And when they're investing into a downstream investment, that company further making investment and acquiring capital company C is permissible. Now, what we need to see is they has to be seen on a fully diluted basis. If there is a CCD, CCPS and all those things, a classic case which has come into the Supreme Court and decided, which is there on the public domain, a foreign company was issued only 10% equity, and CCD, which on a convertible basis would have gone up to the 90%. And they further invested downstream by treating, it is an Indian company only because foreign investment is only up to the 10%. The court said, no, this has to be seen on a fully diluted basis. Who has the controlling power? Who has the control? What are the shareholders' right? Who has the right to change the majority of the director? All these things are to be seen while deciding the indirect FDI, because there are structures which has been framed in the last 10 years. Foreign investment, to keep it controlled, equity is less, class B shares are issued, class C shares are issued, CCDs are issued. CCDs are considered as debt in the balance sheet, but under the RBI they are quasi-equity. So all these things we need to keep in mind while deciding whether the company is a foreign-owned company or the Indian-owned company. Now, when there is an indirect investment which is coming into India, we need to keep in mind that the second level company also has to comply with entry route, sectoral cap, pricing guidelines, other FDI link performance, and as if it is a foreign direct investment directly into the Indian company. So foreign company F investing into the ICO India, which is holding more than 50% by that foreign company. If that company has an investment in ICO, over a period of time, they have generated cash profit of more than 100 crores or whatever the amount it is. We need to keep in mind that when that ICO invest into further downco, which is another ICO 2, all those things entry route, because what you cannot do directly, you cannot do indirectly also. So keep in mind when we are advising at the DI level, which is a downstream investment, we say, okay, where is the foreign investment coming into India? It is all the Indian generated revenue which is going to go into another company. Even there, you require prior approval, or those sectoral caps and all the guidelines policy needs to keep in mind. Okay, so when a first level investor company, when we talk about the first level investor company means the ICO. So when the ICO is investing into a down level investment, what we need to keep in mind is board resolution at that ICO level, approving that investment into another ICO 2. There has to be a shareholders agreement. The investment which is going cannot be out of the borrowed fund. It has to be either foreign investment coming into India fresh, or the internal accruals which has been to be used for the purpose of the investment into the ICO 2 level. So we need to keep in mind is, even though investment is by one ICO to another ICO 2, if that ICO 1 is held by a foreign company, if it is not held by a single foreign company, there are four foreign companies invested into the ICO, it still remains as a foreign owned Indian company. It is not important that it is a single investor at the ICO level. All together are treated as an foreign investment. We have cases where Indians who were holding shares in that ICO, now they have become a non-resident. Whether it will be treated as a foreign investment, the answer is no. They will be treated as an Indian investment only, because the shares were invested, the shares were held by the Indian resident, when they were a resident of India. So foreign investment, we are clear. ICO level 1, we are clear. ICO level 2, we are clear. So we need to keep that in mind, that all these particular due diligence are taken place while investing into downstream investment, because always the catch is, let's say we are a chartered accountant for ICO 2 and the investment is coming from ICO 1, which is an Indian company. So we will feel, no, the investment is coming from the Indian company only. But a due diligence is must, where the investment of the ICO 1, who are the shareholders, where the money is going to come, is all which we need to keep in mind. Because if this is not within the guideline, the chances are the ICO 2, which is not at the fault, because the fault is of ICO 1 only, they can also be penalized for all these contraventions. Now, why I'm being saying it is important, because under the guidelines, it is the responsibility of the chartered accountant, I mean to say auditor, who has to give a certificate. The auditor of ICO 1 needs to keep all this compliance in mind. You may have this outbound investment also, where also again the duty is cast on the statutory auditor. So when we talk about the auditor, the statutory auditor's responsibility is to see all this particular part is being taken care or not. If it is not taken care, then it becomes the auditor's responsibility to qualify the report and inform to the Reserve Bank of India. In NBFC, which is to be audited by the chartered accountant, there is a strict compliance whereby if there is any deviation, it is the responsibility of the auditor to report to Reserve Bank of India. The same responsibility has been brought here while making of the downstream investment indirect FDI guidelines, which we have to keep it in mind. Now, this is the calculation what we need to keep it in mind when I'm investing into the Indian company and that Indian company investing into the another Indian company. So The foreign investment which is coming through Indian company, where we said the foreign investment is into the ICO 1, it will not be considered as a foreign investment if it is not a foreign owned Indian company, as I said. If it is an Indian owned Indian company, then it is considered as to be controlled by resident Indian citizen. The word citizen here is very important because in Fema, everywhere what we have seen is NRI, OCI or foreign. Here to determine this Indian company owned and controlled by resident Indian. So a person can be a resident of India, invested on a Indian basis, but if he's not a citizen, it is not considered as a foreign Indian owned Indian company. It will be treated as a foreign owned Indian company. Now, the only exception here is if it is a was of a foreign company, then it is always to be treated as a foreign owned foreign Indian company. So let me tell you by way of another illustration, foreign investor investing into the Indian company. Now, if that foreign investment has more than 50% in this first level, it will be considered as an foreign controlled only, and the downstream investment has to be complying with all the guidelines as the foreign investor is directly investing into the downstream investment. Now, when I'm talking about the indirect investment, so thus if the Indian company is a foreign investment of 50% or more, and it is controlled by a non-resident through the board of directors, then it will be considered as a foreign investor only. And on the other end, if the Indian company has Indian resident of more than 50%, then it will be treated as a domestic investment. Now, there are certain mirror calculations what we need to keep it in mind. We have already discussed that up to 50% if there is a foreign investment, then it is considered as a foreign owned Indian company. Now, why this percentage has importance is in certain downstream investment, there are sectoral caps. So if there are sectoral caps, foreign investment investing into the Indian company, their percentage is important when they are making investment into the another. So if the foreign investment is 60% in the Indian company and investment by that investment Indian company in downstream company will be entirely considered as a foreign indirect foreign investment, and it will not be restricted to the 60%. However, if the foreign investment has 100% in this Indian company and they invest 40% down, then it will be treated as a 40%. So that care we need to keep it in mind. Okay, when I'm calculating any, this is the most important thing. All the participants who are present over here needs to keep it in mind that when a foreign investment is at 60% and if that downstream investment will be entirely considered and it will not be restricted to 60%. So if the foreign investment in the Indian company is say 40%, then the entire 40% will be considered as a, but sorry, what I was saying is if a foreign has 60% and they're investing, it will not be restricted to 60%. But if the foreign investment is 100%, it will be considered if investment is 40%, then it will be 40%. Let us go back to the right issues. When we are talking about the right issues, one normal thing which comes to my mind is I am issuing shares only to an existing shareholders. But let me tell you, people are taking advantage and right issues are only issued to the existing shareholders. But if they are not subscribed by the existing shareholders, it can be renounced in favor of the other parties. So now who can have a right issue? Any Indian company can go for the right issues. Of course, the right issues has to be as per the Companies Act. Sectoral caps are not breached. For the listed companies, the right issue has the different parameters. We have the identical case of right issues in a partly paid shares of Reliance Industries, what we are seeing. So all those things are available to us. What we need to keep in mind is right issues are allowed to everybody, to the existing shareholders, but we need to see that in right issue, the share price which is being issued to the Indian shareholders, the same price are available. Now, repatriability as applicable to the original shares are most important, because if the repatriability clauses are there for original shares, same thing applies for the right issues also. Now, under the NDI rules, can even acquire right issues renounced by person resident in India in favor of person resident outside India, which is not the case. It can also subscribe to, where there is any oversubscription, then it can be renounced shares can be adjusted against those number of shares. So all this we have been talking till now is about the Schedule 1, which is on a repatriable basis. Now let me say Schedule 4. I will come to the Schedule 1, other questions which could not be answered. 2 questions were there. Now coming to Schedule 4. When we are talking Schedule 4, friends, let me tell you, just keep all the knowledge we have gathered in Schedule 1 aside, because Schedule 4 is very simple, very non-requirement of various guidelines, various provisions, and what we need to keep in mind is simple few points, and you are in compliance with Schedule 4. So when we talk about Schedule 4, only the investment which is coming to India is on a non-repatriable basis. But again, under the $1 million scheme, that money can also go back. But let us now concentrate on Schedule 4, which says dividend is allowed to go back. It can be repatriated. Interest also can be repatriated. When I say interest, means if there are any CCDs which are being issued, only what cannot be repatriated is the principals, gains and all. But under the $1 million route, everything is repatriable. This is what we have seen. Now, NRI's PIO, OCI can buy shares, CDs, warrants on a non-repatriation basis. Answer is yes, because whatever guidelines, restrictions apply on a Schedule 1 doesn't apply over here. You can issue equity shares, and equity shares include CCPS, CCDs and all those things. What care needs to be seen is investment will be treated as a domestic investment. You don't have to file FCGPR. Earlier, there was a reporting within 30 days of the shares money coming in. Now that has been done away with even in Schedule 1, but in Schedule 4, this was never to be considered for all this purpose. We had a cases where investment was on a Schedule 4, but certain reporting were done earlier. Even then, no problem. You can write it again back to the bank and say, I want to treat it under Schedule 4. Anything which has come in Schedule 1, you can treat it as a Schedule 4. But anything which is coming in Schedule 4 cannot be treated as a Schedule 1. Keep that in mind. Only there was a big list of prohibition at the time of Schedule 1, whereas in coming to Schedule 4, Nidhi, chit fund, plantation, farmhouse, dealing in TDR, real estate business, only these particular things are considered as prohibited category. Most important thing, friends, what we need to keep it in mind is the plantation is prohibited under Schedule 4. But if you go to Schedule 1, agricultural activities where the FDI is allowed, the plantation is allowed over there. So this is again a area where the law which has been defined by the Reserve Bank of India, by the Government of India, they may have something in their mind. Here, these are the 4 categories what we need to keep in mind, which is not permissible under the Schedule 4. Other than that, retail trading is allowed under Schedule 4. Single brand retail trade is allowed under Schedule 4. But what we need to keep in mind is foreign companies cannot come under Schedule 4. It is only the NRI, OCI, and the foreign company which is owned by such NRIs and OCI can come under the Schedule 4 investment. So we had a classic case where single brand retail trade was prohibited earlier under the Schedule 1. So the client said, why don't we come under the Schedule 4? The easiest answer was Schedule 4 is permissible for the NRI, PIO, OCI and all those things, but it is not permissible for foreign investors who are like Mr. Tom, Mr. whatever relating to the foreigners. Okay. Now, when we are talking about on a non-repatriation basis, everything is permissible. Non-resident investment includes investment in listed securities, equities, CCPS, CCDs. Everywhere what we are seeing, it is not prohibited, it is not allowed in the Schedule 1. Even non-repatriable, non-repatriation is allowed as a sole proprietary's firm capital, partnership firm's capital, or everywhere this is permissible. Now, under the partner's capital or sole proprietary capital, residential status, when they start this business under sole proprietary, whether they will be resident or not, we are not touching on these areas. All what we are saying is non-repatriable is the easiest method. You can do 99% of the things for your client, except these 4 categories. Other thing, all are considered as under the automatic route. So the most important restriction is OCPS, NCD, OCD, RPS. Though investment is domestic, instruments remains the foreign, because even on a non-repatriable basis, if you see Schedule 4, what is allowed to be allotted is only the equity shares, and these do not fall under the equity shares. So keep that in mind. Now, Schedule 4 is open to NRIs, citizens who are settled abroad, even foreign companies, trust. This was not there, my friends. In the last 2-3 years only, they have included this particular part, because many investors do not want to come directly NRIs and PIO, but they want to come through a foreign company where their holding is substantial, own and control, what we refer to. Even those are allowed to invest into the Indian company. The very good questions are asked is, are they allowed to open the company? The answer is no. The foreign companies are not allowed to open the company. Investment come directly into the Indian company. Dividends are directly issued over there. Only when you are diluting or redeeming your equity shares, then the foreign company can apply to Reserve Bank of India. They give the permission to open the bank account and hold the shares. The question also comes from the various corporate is, once I liquidate and the money comes in, $1 million scheme is not available to the foreign company. Hence, we should keep in mind is, foreign company, if they want to bring the money into India and remain invested in India, then only they should use this route. Otherwise, NRIs should come on the individual level, so that when they redeem the investment, when their cycle of investment is over, they can take back under the $1 million scheme. So this own and control, what we were referring to, there is no definition, but we go with the common parlance. When we talk about own and control, 50% of the share capitals are owned by the NRIs, and the foreign trust, which is also famous abroad, they can also invest into India, because if the beneficiaries of this trust, the trustees of the trust are all NRIs, then they are treated as an eligible investment or the eligible entity to invest under the Schedule 4. Now, what are the benefits? We have already discussed. No pricing norms, no filing of any FCGPR, not counted for the direct limit, indirect limit. They are treated as can invest into the multi-brand, telecom, airline, no restriction, no barrier to investing into the tobacco, gambling. Everywhere this is permissible, except those 4 categories what we have seen: cheat fund, nidhi plantation, farmhouse, real estate, dealing in real estate, and this. Other than that, everywhere it is allowed. Now, the golden rule is, can NRI remit the money under $1 million? The answer is yes. However, the Schedule 4 says the amount invested under this schedule and the capital appreciation thereon shall not be allowed to be repatriated abroad. This is specifically to this particular guideline. But if you go back to that $1 million scheme, any money lying in the NRO account is eligible to be sent on a $1 million basis. So we keep in mind, and friends, let me tell you that $1 million limit is not applicable for dividend and interest. They are the current income of the foreign investors, I mean to say NRI, and NRIs, there is a form called RCI, which is prevalent from the FERA regime, which talks about repatriation of current income. You go on the RBI website, it's very clearly mentioned, okay, this $1 million scheme is over and above the money which is allowed to be repatriated under the current income. But the gray area earlier and now vouched by the Reserve Bank of India, which says share of profit from the partnership firm will be considered as a repatriation of current income. However, share of profit from the LLP will not be considered under the RCI, and they will fall only under the $1 million scheme. Why two views on a partnership firm versus LLP? Answer is best known to Reserve Bank of India. But what we understand is LLP is considered quasi company, but then again there are wise minds which says the share of profit of LLP and the dividend both should fall because both are taken away by the shareholders and the partner. Again, RBI said, dividend is defined separately and share of profit from the LLP is considered separately, which is under the capital nature, and it will not be allowed under the RCI, but only under the $1 million scheme. Now, before going to the case studies, or let me complete my case studies at a stretch so that we are having a ample time for all the other Q&As. Now, here is a case whereby Mr. A has invested in shares of the Indian company while he was a resident of India. Now, Mr. A has moved to USA and is a non-resident of India. He wants to sell the shares of the ICO to another non-resident. Whether Mr. A shall be required to comply with the pricing guidelines in respect of proposed sale of shares, whether Mr. A can retain the funds received on sale of shares in his US bank account. Let me tell you, friend, now Mr. A has moved to USA. He has invested into this ICO when he was a resident. Now he's selling shares to another NRI or an OCI. He's selling his shares to another non-resident, not being an NRI and OCI. In such scenario, the investment money or the sale proceed has to come into India and all the other pricing guidelines will apply. Why this specific question is raised? Because when there is a transfer from one NR to another NR, there is no permission which is required. It is under the automatic route. Pricing guidelines doesn't apply. But Mr. A, who has moved to USA and an NRI, but the shares were held under the Indian account, hence the money, Fema do apply, and what the money has to come to his NRI account over here, and it cannot be retained in the US. I hope I made myself clear. Now, another non-direct investment, foreign investment, ESOPs. What we need to keep in mind is an Indian company may issue ESOPs, sweat equity shares to its employees, directors, or even to the employees, directors of his holding company. Or if I am in Indian company, I have a joint venture abroad, even that is allowed. But all what we need to keep it in mind is these are all under the guidelines which is being under the SEBI companies, whatever rules it applies. So if FDI in such entity falls under the approval route, then ESOP should also require the approval route. So we need to keep that in mind, that if there is an approval at the initial stage, ESOPs also approval requires approval. If FDI is permitted under the automatic route, then the ESOPs to be issued to the foreign party do not require the approval route. However, ESOPs to the citizen of Pakistan and Bangladesh will require the government approval. Now, when we are talking about the merger, demerger, amalgamation of the Indian company which has a foreign investment into India and they are getting merged. So when we go to the NCLT or the earlier High Court, they ask for a specific certificate, they ask for the specific approval from Reserve Bank of India, and they take a declaration from the company that when there is a merger which will take place, the sectoral cap will not get breached. So we have a case of a pharma company where earlier only up to 24% which was allowed in a brownfield project years before. And when there was a merger of an one company to another company, it was breaching that cap, and hence that approval did not go, the merger could not go through because that was breaching. So what had to be done is the shares by a foreign investor had to be first transferred to the Indian company, and the merger took place in phase 2. Now, if that initial investment requires central government approval, then the merger will also require the central government approval. So all these things needs to be kept in mind, that what is allowed directly is allowed indirectly also, and what is not allowed indirectly, or sorry, what is not allowed indirectly cannot be allowed indirectly also. So now what we also have to see is the transfer. The transfer should not be engaged in the prohibited sector. So you invest FDI into one company and then you want to merge into another company where the FDI is not permissible. RBI will not give you the permission, whereas the NCLT will also not consider this as an eligible case for the merger or as well as the demerger. Now, what we need to keep in mind is when we talk about the proprietary concern, partnership firm, earlier there was permission which was required, all those old era. Now Fema in this 20 years has liberalized over a period of time, and you don't require any approval. On a non-repatriable basis, any money can come into the proprietary account, any money can come into the share capital of the partnership firm. But what we need to keep it in mind is, A, what was prohibited under Schedule 4. If the same activities are carried out by the proprietary concerns also firm, then there will be a issue. So as I said, restricted sectors for NRI is the same: agriculture, plantation, real estate business, print media. There is a specific prohibition to these things. Now, let us come to the Schedule 6. Various, what we are seeing, all the professionals, this LLP, which started in 2008, found the traction, and now it has become the benefit for all, because in LLP there is no dividend distribution tax which used to be earlier while declaring the profit to the partners. Now, what we need to keep in mind while doing an LLP transaction is, in LLP, if it is a 100% FDI allowed, then only you can bring the FDI into the LLP. If the LLP is into some sector which requires some performance, like performance link relating to the retail sector, performance link relating to the multi-brand retail store, performance link to the construction activity where there are certain performance link condition, then FDI is not allowed. Keep in mind, you cannot bring FDI into those LLP which has certain sector relating performance conditions which are prescribed in Schedule 1. FDI in LLP, when I refer to Schedule 6, again it refers to Schedule 6 on a repatriable basis. Now, there are certain sector-specific restrictions. They cannot have the FDI sectors eligible to receive less than 100% FDI, what I was referring to, radio, print media and all, mining, all those things which has a less than 100%, FDI is not allowed. LLP. Keep that in mind. Now, sectors which are permissible, prohibited at one level, again prohibited at this level. Downstream by LLP, not in control by resident, again prohibited. Now, so this 3 lines at the last is the final mantra. FDI in LLP allowed, allowed only in Indian companies, that too only with the sector up to 100% and no performance. So when I refer to FDI LLP 6, it again go reference to FDI 1 category for the sector specific to decide whether it is allowed or not. Again, to be kept in mind, downstream by LLP, not owned and controlled by resident, not allowed. So again, what is not allowed directly, you cannot do even at this sector. 2008, contribution, capital, all whatever LLP Act do refer to, everything applies even here. All valuation guidelines, whatever is there in the LLP law, applies even at the Fema level. Only keep it in mind is when I'm giving the LLP investment from abroad, keep it try to keep it as simple as possible. I am keeping at a particular percentage, I bring that much contribution. Answer is yes. Only cash consideration can come in, means by way of FDI, what you're bringing in. There is an FDI LLP 1 form which has to be filed at the time the money comes in, and at the time of liquidation, means or there is a change in some percentage on the FDI LLP, 2 forms comes into the play. Funds can be received from NRE, FCNR account. Now, LLP is not allowed. For whom? Foreign investors like Pakistan, Bangladesh, FVCIs are not allowed. Sector where there are 100% is not there, it is not allowed. So all this we need to keep in mind while giving a guidance on the FDI in LLP. Because every time we have seen is the contravention which has taken place, many a times it is all linked to the LLP, because we look to the LLP concept where the money comes in. It is easy because there is a no dividend tax and all. After payment of tax, it is easy to send the money back. Hence, all this particular part when we are giving advice needs to be seen Schedule 6 for the LLP. Now, let us come to the various reportings before we move to the other section. Now, we have all gone to the firm's portal. So what we need to keep in mind is, at the firm's portal, you have an entity master form, you have a single master form, which needs to be filled in at the time of creating the registration of the company. Once the registration has been created, then when the money comes in, you need to file form FCGPR for the foreign direct investment, Schedule 1. For Schedule 4, there is no need of FCGPR form. When it comes to Schedule 6, there is a separate form mentioned in the year sheet, PPT, LLP 1 and 2. So when we are talking about FCGPR, we need to keep in mind within 30 days, you need to comply with these guidelines. Now, advance reporting form is done away with. There is no requirement. Any client who asks us our advice while doing these FCGPR formalities, please keep in mind is when I am referring to FCGPR, whatever paperwork are required, make sure that those paper comes in advance before the money comes in. Because once the money comes in, we have seen many times that within 30 days, the FCGPRs are not filed. And don't wait till the last minute for FCGPR, because if you have filed within 30 days and if there is any paperwork which is not submitted and the authorized dealer rejects it, then the chances are the new form when you submit with the details, that date is considered as the date of filing FCGPR, and the late submission fees can be made charged to the client. So now there where people who are doing with this LSF and all those things are aware that when we are filing from FCGPR and if it is a delayed, they automatically calculate what is the late submission fees and they tell us whether are you interested in paying this LSF or not. If we say no, then those old procedures of compounding or other things do apply. FLA, foreign liabilities and asset. Any Indian company which has received any foreign direct investment in Schedule 1, 2, 3, 6 on a repatriable basis, all needs to file FLA. There are other areas also where FLA is required to be filed, but since we are on this foreign direct investment, what we need to keep in mind is FLA is mandatory. Non-filing of FLA within the time attracts 10,000 rupees of compounding fees, which the RBI is being levying. So keep in mind that FLAs are filed in time. Now, when we are referring to FCTRS, FCTRS is basically the transfer of shares. Any transfer between resident to non-resident or non-resident to resident, it requires capturing of the data on the firm's portal. FCTRS, it can be any way around. Earlier, in people who have been handling Fema pre-firms portal, then FCTRS has to be submitted by non-resident. Now FCTRS has to be filed by the companies whose shares are getting transferred. Hence, every detail which is required for the purpose of FCTRS needs to be covered, received from the buyer, from the seller, by the company, so that it is available for uploading the same. Only once the authorized dealer approves the transfer, then the company should transfer those transactions. Before that, if you record those transfer, it will be considered as a violation, contravention, which attracts compounding. Form ESOPs. When we are talking about the form ESOPs in this schedule is when the foreign NRIs are issued ESOPs of the Indian company. There is one more form ESOPs which is applicable even for the outbound investment, whereby shares of a foreign companies are issued to the employees, directors of the Indian company, which is a subsidiary, or foreign investments, outbound investment shares are issued. There also you have to submit under the outbound guidelines. When we are in foreign direct investment in India, we talk about the inbound. Again, form ESOPs at the time of issue, at the time of granting, the form is clear. We need to keep in mind, please download how every year we download ITR forms and go through all the conditions. Every year we get the new ITR, which sometimes FA schedule is introduced, sometimes schedule 1, schedule 2 is introduced, asset liability statement is introduced. So here also, all the professional brothers, sisters who are handling this FEMA part, be sure that you have the printout ready before the money coming in, before the transaction taken place, whether it is transfer, whether it is ESOPs, so that we are ready with the questionnaire, we are ready with the guideline as to what all documents is required, and they are handy with us before uploading the same. Now, when we are talking about LLP, any contribution which is received from the foreign partner, any share of profit which is being given to the person resident outside India needs to be reported in LLP 1 form. There were a difference of opinion where on a year-on basis, when the share of profit is getting transferred to a partner who is a person resident also outside India, whether you need to submit LLP 1, RBI has said yes, LLP 1 is required, because through LLP 1, RBI wants to capture what is the total amount of capital which will be going outside India when the partner resign, partner or the LLP is getting closed. So this capturing of the capital contribution or profit share needs to be done under the LLP 1. LLP 2 is at the time of disinvestment. If there is any transfer of capital contribution, anything going outside India, because of this LLP 2 year, where any transfer of capital contribution or profit shares is required to be reported here, their RCI form where they gave a bifurcation between the partnership firm and the LLP, they are saying because it is LLP 2, we are treating it as a capital and it will form under the $1 million scheme and it will not form part of the RCI route. When I'm talking about the DI form, when the downstream investment take place, the first level company has to report on the RBI portal about the DI form. So keep this in mind. Okay, DI form is mandatory to be filed. Again, DI has to capture at 2 levels. When there is an investment by a foreign into Indian and Indian into the other downstream investment. So this all particular part we need to keep in mind. This is my suggestion to the people, coordinators, and everybody, that these particular forms, which how to fill in, what care needs to be taken, you should have a separate session to go in depth into the same, so that we are clear that all the professionals who are handling such assignments are clear and they do not carry out any contravention, because it is rightly said by the client, when there is any contravention, the whole blame puts on to the chartered account. Sir, ये तो आपको करना था, ये तो आप जानते थे, हमने तो investment लाया, rest every duty is on us. So keep that in mind, so that filling of all these forms, these are the 7 forms. There are more than 20 forms which is to be filed today. Under the FEMA regime, erstwhile FERA, no problem, because everything was under the approval route. You cannot go wrong. Under FEMA, with the liberalization, all things are linked to the form, and we see the maximum cases of compounding which has come in the last 5 to 7 years is because clients blindly carried out the transaction. They do not report to the chartered accountant, they do not report to the authorized dealer, all resulting into the compounding and the penalty amount which is being levied. So what we discussed today is all linked to the foreign direct investment, and what care all we need to keep in mind has been discussed, and I tried my best to keep it as simple as possible, so that it goes to all the strata of professionals who try to understand and keep that in mind, what all activities or strategies we need to develop while investing into India. Last advice to all the 325 participants over here is, when you are dealing in FEMA, try to keep the structure as simple as possible. Try to keep it plain without any double interpretation possible, because in FEMA, whatever RBI said is final. There are very less number of cases where it is appeals and all those things. All what is available in FEMA is the compounding, which is accepting your mistake, or else you go to the enforcement directorate. And I'll tell you, with the experience what we have, nobody wants to go to the enforcement directorate during the lifetime. With this few words, I'll thank the Borivali Central CP Study Circle for giving me the opportunity to go through all these things. And with the permission of the coordinators, if we can go to the Q&A. Shreyans
Yes,
bhai?
sir. Yes, sir. Yes, sir. You can go to question and answer.
Yes.
If you can you go through it right directly?
Yes, yes.
Yeah,
So
please.
first question is by Subramanya Bhatt. NRI OCI partners capital in LLP through the NRO account, whether considered as an FDI? The answer is no, it is not considered as an FDI. It will fall under the non-repatriable basis only. Only when it has come through the NRE, FCNR, or foreign from overseas, it is considered on a repatriable basis. Can you please explain the remittance procedure on the sale proceeds of unlisted company by a Can you please explain the remittance procedure on sale proceeds of unlisted company by non-resident? Okay. The procedure is very simple. When a non-resident invests into the India, they are coming on a Schedule 1 basis, because I presume we are talking about non-resident means the foreign citizen and not the NRI and the OCI. So when they invest into India, we will restrict ourselves to the FEMA. So the money has come in. Indian unlisted company has issued allotted shares to the foreign party. FCGPR has been already filed. Now at the time of sale proceed, this foreign company can either sell it to another foreign company, 2, it can sell it to another NRI OCI, or 3, it can sell it to another Indian resident, whether it is a company or an individual shareholder. The procedure is simple. FCTRS has to be filed when it is a transfer between resident to a non-resident. In this case is non-resident to resident. When it is non-resident to another non-resident, You don't require any approval. You don't have to file any form. Only the Indian company will write to the authorized dealer, okay, earlier the shares were held by this foreign company A, now it will be held by this foreign company B. Of course, the TDS provision, 195 certificate, whatever is required while making payment, we are not touching upon. Under Fema, only FCTRS is applicable. And of course, it goes without saying, Schedule 1 investment. So the whole money, even after all the appreciation, is eligible to be repatriated outside India. Can an NRI who has inherited money during the year repatriate the same under $1 million scheme? Sanjeev bhai, the answer is yes. $1 million scheme. If you go to the master direction on $1 million scheme, even the inherited money is allowed. Forget the inherited money. Even if there is a family settlement between the brothers and one brother is an NRI, and if this money is being paid by another brother in India, then even that $1 million can be taken. LLP is formed with FDI. After 3 years of LLP made a loss, it is decided to close the LLP. However, there is some amount lying to the capital account of one foreigner and some amount lying to the debit of other foreigner. How to close the LLP? Do we need to make payment and receive from other, or we can write off? Friends, write-off formulas, please do not use when you are dealing with a cross parties. Foreign parties, foreign bodies are not eligible for the write-offs. You will have to bring from A and you will have to pay to B. That is what the RBI rule says. FDI LLP1, whether required if it is under Schedule 4. Schedule 4 is on a non-repatriable basis. You don't require FDI LLP1. It is only when you come under Schedule 6 where you require. In case of Indian company, which is subsidiary of the foreign listed company, can employees of Indian company receive ESOP shares of holding company listed in US? This is covered in the outbound foreign securities being issued to the Indian company. Indian company will have to file form ESOPs, which is available even for the outbound investment, where the answer is yes. The Indian company, which is a subsidiary of foreign company, the employees of Indian company can receive the ESOPs. Forget about the Indian company, even the directors of the Indian company, the independent directors of the Indian companies are also eligible to receive shares as an ESOPs from there. In spite of various requests, Bank of Client has not issued KYC, only issued FIRC. So Indian company receiving FDI could not file LLP 1 in time. Ultimately filed without KYC but rejected the same. Friends, let me tell you, KYC is the basic fundamental document for the bank in India. Bankers do not know who the party is investing into LLP. You know the foreign party who is investing into LLP. But at the bank level, what is important is the KYC. Banker says we don't want the foreign money if the KYC is not there. FIRC is only confirming that the foreign investment or the foreign currency exchange has come into India. Till KYC is not there, let me tell you, shares, they will not take it on record and they will keep on rejecting it. LLP investment was made by one non-resident company. The non-resident company is closed. The contribution is transferred to the new company. How to comply with it? See, again, as it said, it is as good as a set off. If one LLP investment was made by one non-resident company, and if the non-resident company is closed, before the non-resident company gets closed, we have to transfer the contribution from company A to company B and send the money to company A and receive the fresh money from company B. Netting off or transferring assignment is not permissible. Singapore, UK, who do not have a foreign exchange regulation, their all assignments are permissible, but India still do not consider such assignments and they have to go on case-to-case basis. Queries relating to the LLP. Two NRI partners in an LLP which had brought the fund in the LLP by way of loan from NRO account. Do we need to report it to RBI? See friends, there are two things. One is the current account and one is the capital contribution. If it is a capital contribution, you need to report under LLP1. LLP cannot take loan from this because if you see the Fema guidelines on the loan, LLP cannot receive loan. So it has to be by way of capital contribution only. The LLP has been suffering losses in India from its inception. Is annual reporting mandatory under form LLP1? The answer is yes. one of the NRI partners has stepped down as a partner and he's been given away the rights in the loan and capital is not payable, do we need to report the LLP? If the NRI partner who has stepped down, if LLP1 was filed, and if he's now given away the rights in the loan and capital, then again LLP2 has to be filed because LLP1 talks about what money comes in, what is the capital contribution which is brought in, what are the other share of profit on a year-on-year basis is getting accumulated in of that particular NRI partner. All these things get captured in LLP1. LLP2 is getting away with, okay, this money is being paid, this is the what the balance is being left over. So LLP2 is mandatory. Indian holding company is an exporter as well as importer of services, which is a subsidiary in. See, as I said, this is not relating to this question of my today's session, but let me tell you, if it is services, set off is not permissible. You go to the guidelines. If it is import of goods and export of goods to the same party, and within that 180 days, you can set it off. But when it is the services, setting off is not permissible. Dear sir, but KYC is issued by the banks only. Same bank is not issuing KYC, but still rejecting LLP1. Let me tell you, friend, KYC is issued by the foreign bank to the Indian bank. So if the foreign banks is not issuing KYC, that means there is some issue with the foreign investor relationship with that foreign bank. Hence, as I said in my presentation, whatever documents is required, please make your client aware of the same. This will be required while filing Form LLP1 or FCGPR or FCTRS. KYC is, of course, a transaction between bank to bank, but till the Indian bank doesn't receive it, Bhavesh bhai, this will never be taken on record. Mark my word. I think with the time allotted to me, we have tried to cover all the Q&As in the presentation so that we don't reach into the Kirit bhai's time. With this, I thank you everybody for the patience hearing. Thank you very much once again.
Rajesh bhai, can I ask you one question?
Yeah, please.
As you said, suppose if there is an Indian company having resident as well as non-resident shareholders, now company is coming out with some right issue, and non-resident shareholders are not willing to subscribe for that. They are ready to renounce in favor of resident shareholders. Do they have to intimate or take RBI permission or anything?
No permission required, because the renunciation is from non-resident investor to the resident investor, so no permission is required. Even at the time of renunciation, other way around also no permission is required. And because all what we need to keep in mind is, by such renunciation, if there is no breach of sectoral cap, that care we need to take. Because if there is a breach because of this renunciation, then you have to go and get the approval, which is very difficult to obtain now. Hence, advisable, do the renunciation of only when your company falls in the 100% sectoral cap.
Secondly, this FCGPR, suppose company has issued shares to non-resident in a series 1, 2, 3. Now, nowadays, RBI is not allowing you to upload the second FCGPR unless first FCGPR is approved. So now first FCGPR has not been approved for some reason or some technical reason. So automatically the second FCGPR gets delayed. So whether in such type of cases compounding will come up, or that can be condoned?
No, compounding is part 2. See what RBI is trying. Even RBI has gone in totally onto the digital format for the FDI. So RBI is trying to cover a situation. First investment which has come in, you have not complied with the guidelines. It is not taken on record. I am blocking your entry. You will not be allowed to issue shares on the second. And if you have issued second, even that will be a contravention violation of the period, because you will not be able to upload within the 30 days time. And again, that will attract the LSF, late submission fees. So we always tell client, either for the import export, there is an IDPMS, EDPMS which has come in. For FCGPR, this particular firm's portal has come in. All we need to match as an auditor whether all these things are captured or not. If it is not captured, we are giving advice even in the audit program. This is a mandatory for a foreign investment which is coming to India, to please see if the shareholding as a foreign investor, whether the firm portals has captured everything, because when the firms portal came in 2017, any investment which was received prior to that, there was an entity master form, single master form, which had to be uploaded, capturing all those foreign investment prior to 2017. All these things have been done or not. We are getting various such cases as even today, Sharad Bhai, that allotment of share was done in 2010. Accountant is not about all these changes. Now in 2021, they received a new form, new investment. And we cannot do it because still old things are not captured. Because once you don't capture old one and you issue the new one, the old thing will never get captured. So it is mandatory to capture the old one, then only the new thing will get captured. Because there is a column, what is your foreign investment prior to this allotment? So when you are making allotment number 2, your foreign investment percentage at the time of allotment number 1 needs to get captured. I hope I made myself clear.
Yeah, very much clear, sir.
Great. Thank you.
Thanks a lot, Rajesh Bhai, for such a wonderful and detailed presentation. I'll now request our past convener, CA Kirit Mehta, to propose well-deserved vote of thanks to the speaker.
Thank you, Sharad Bhai. Good evening, members. You all agree with me. Rajesh Bhai has nicely explained in detail about FDI, including recent changes in policy, all types of instruments, applicable pricing guidelines, automatic route, approval route, etc. In the second part, he has also covered investments can be done in Indian entities by direct and indirect route. We are also thankful to him for resolving queries of our members and sharing his expert knowledge with all of us. Sir, BCS is thankful to you for sparing your valuable time with all of us. Thank you very much. Thank you.
Thank you.
Thank you.
Thanks for the patience here.
Members, we will have a 5 minutes bio break. So please join by 6, 7, 3.
Meantime, Kirit Bhai, you can just take a trial. Kirit Bhai, trial revision.
Yes. Unmute karo, sir. Kirit Bhai.
Okay, yeah. It's good.
You are on mute, sir.
Yeah, it's good. We can meet in 2 minutes.
I'm
Yeah. Kirit Bhai, you are.
yes. चलो ब्रेक ले लो.
Yes, yes.
Sharad bhai, am I audible?
Yeah, very much, very.
Okay, okay, good.
2 minutes. We can start in 2 minutes. Right?
Sure. Right.
Kirit bhai, can we start?
Yes. Fine,
Yeah, let Kirit.
Yes, Sharad bhai.
Yeah.
Start.
Yeah. Good evening, friend,
Yeah.
once again. Welcome once again to Kirit bhai. Kirit bhai will take us through the acquisition of immovable properties in India by non-resident, because since India is a very good opportune place for investment into immovable properties, mainly for non-residents. So I'll request Kirit bhai to take his session. Please,
Yeah.
Kirit bhai.
Okay. So thank you so much, Sharad bhai. Sharad bhai, Hiren bhai, and Srens bhai. So thank you so much for welcoming me to your study circle. I am your neighbor only. I live in Daisar. And yeah, study circle is very dear to me because I have been got opportunity to found Daisar CP study circle. Right. I got that. So thank you very much once again. And after listening to Rajesh, like a marathon, like he has dealt with so minutely with all the provisions. This topic is a very small topic. I'm sure you are going to like it because I'm not giving to I'm going to share about this topic in a illustration manner. Like there will be few case studies I have made so that you can also apply your mind. What will be the answer like this? Inquisitive, and then when you get the answer, uh, that answer will remain with you like for a longer period. You will become a master. And this topic is also very like many times now and then we get to know from our NRI clients. I'm sure all of you maybe some of the times NRI may be asking whether I can buy this property. I want to remit money outside India. How much money I can remit? What precautions to be taken? Sometimes some questions comes and then you have to really answer them. And if you answer them correctly, that will be a value addition for all of us, right? So with that intention, let's go to the subject proper. So there are total 16 slides, not right within 1 hour. I'm sure we will be able to cover. And even if we can cover, we can complete within little bit earlier. Then also it's Saturday. We all can go early. All right. So yeah. So there are very few provisions right now, under regarding this topic, and this topic is like investment in immovable properties by non-resident. Right? The topic is like non-resident, not only foreign nationals, but just non-resident in general. So the acquisitions of immovable property in India is a capital account transaction. You may have learned in other topics that what is current account transactions and capital account transactions. So it is a capital account transactions. As we know that capital account transactions are regulated and they are generally not permissible unless specifically permitted by RBI. So there should be specific provisions under which this transaction is permitted. So there are specific provisions under Fema. Earlier there was a notification Fema 21. Since 2000 we used to study Fema 21 for acquiring immovable property in India. But in 2019 that notification is merged with rules, non-debt instrument rules 2019. So with this basic structure of knowledge, where the knowledge is contained is in the rules 2019. So prima facie, in case of property, nobody can buy agricultural land, plantation property and farmhouse in India, right? Even if he's a NRI, whether he's a PIO, whether he's a OCI card holder or any, he cannot buy under automatic route for sure, agricultural land, plantation and farmhouse in India. And there are restrictions on 11 countries, citizen of 11 countries, right? So, all our neighboring countries, the citizen who are a citizen of Pakistan, Bangladesh, Sri Lanka, Afghanistan, China, Iran, Nepal, Bhutan, Macau, Hong Kong, Korea. So citizens of these 11 countries cannot buy. So even if suppose today I go to Hong Kong and for some reason I take the citizenship of Hong Kong, then I become a citizen of Hong Kong, then I cannot buy a new property in India under automatic route, right? Because these are our neighboring countries. So this is one restriction you keep in mind. You keep in mind 3 properties, agricultural, plantation, farmhouse, one cannot buy in India. Then 11 countries, citizens of 11 countries cannot buy. These 2 restrictions keep in mind. Okay. Now there is one more concession is given by in the Fema, that if a person, like suppose for example, I am right now owning a house in Mumbai and I am owning various other properties in Mumbai, and tomorrow I become a non-resident, then I have been allowed and permitted under automatic route to hold whatever assets I am holding right now. I can invest, I can get the income, I can reinvest. So that facility is given to me, and when I become a non-resident. So this also section 6.5 also you can keep in mind. Okay. Yeah. So now just a minute. This is, yeah. So now who can acquire property in India? So what are the under automatic route? We would love to have automatic route, right? We don't want to go to RBI for any other. So whatever is easily available under automatic route, these are the provisions. So only NRI, non-resident Indian, or OCI card holder can buy property in India in general. So what is the meaning of NRI? So NRI, there are 2 different definitions for NRI and OCI. NRI is someone, see, non-resident Indian, right? So someone who is a citizen of India, for some reason, he has become a resident outside India, right? So he is a NRI. And the OCI is that somebody has become a citizen of other country, but he's having certain, he's fulfilling to certain criteria, like he was born in India. Like for example, I go to USA for employment, right? And after staying there for 8-10 years, I take the green card. Then I become a citizen of USA, but I was born in India, right? So there are conditions like to have a OCI to possess OCI card. The condition is that he who was a citizen of India, right, at the time or after the commencement of the constitution, or various other conditions. Or if you go to this condition, who is a child or grandchild or great grandchild of such a citizen. So I suppose, for example, I am I am a citizen of say USA, right? So if I maybe fit into the first condition, like who was a citizen of India at any time. But if if my father was a resident, citizen, or my grandfather or my great grandfather was a resident citizen of India, then also I fit into that eligibility for OCI card, right? And other than this, one more interesting thing about OCA card is for the spouse, spouse who is a born and a citizen of other foreign countries, right? So for that, if you read spouse of a foreign origin of a citizen of India, okay, or a spouse of foreign origin of a overseas citizen of India, right, whose marriage has been registered and substituted for a continuous period of not less than 2 years immediately preceding the presentation of the application. So, for example, I am settled in USA and I took the citizenship of USA and I got married over there, and it is only 1 year, just my 1 year has passed. So my wife, like foreign citizen, cannot acquire OCI because only 1 year has passed, right? So minimum 2 years and the registered marriage should be registered. So these are the basic provisions for NRI and OCI. Yeah, let's go to next. Yeah, so there is certain, sometimes we get confused. If there is a provisions like OCI, NRI, what is PIO, right? So person of Indian origin concept is still there under Fema. But in case of properties, the concept is overseas citizen of India. And it is very restricted definition of OCI. Now we will see the definition of person of Indian origin. Prima facie not relevant to us for acquisitions of property in India. This definition is not relevant to us. But I am drawing your attention to this definition because at the time of remitting money outside India, Rajesh has already shared about $1 million scheme. Who are the NRI? So definitions of NRI is same in property regulations and this deposit and remittance regulations. Yeah, but in case of property, yeah, there is a concept of OCI. So let's look at the PIO. So in case of a remittance of money outside India or putting money in Indian banks like in an NRO account, NRE account, FCNR account, all these things, this PIO can do that things. So PIO means a person resident outside India who is a citizen of any country other than Bangladesh and Pakistan. So only two countries are excluded, Bangladesh and Pakistan. Yeah, and then this again certain who was a citizen of India by virtue of so and so, and who is a spouse of a foreign origin of a citizen of India. So there is no restrictions of continuous marriage of 2 years, registration of marriage. There are no such restrictions. Why there is a liberal definitions given here? Because government wants people NRI to invest in India, at least put money in India in NRO account, NRE account, and for remitting money outside India also they don't mind, right? But in case of property in India, the definition is very strict. There is a concept of OCI. So I hope you all understood distinctions between the definitions of OCI and PIO. Okay, got that. Now let's go to yeah. So suppose your client comes to you, right? So these three questions you can definitely keep in mind. Now client comes to you, some NRI clients, yeah, I want to buy a property in India. Okay, so first check whether he is a citizen of 11 prohibited country, Nepal, Hong Kong, Macau. If yes, then not eligible. Yeah. Then ask him what you want to buy. Do you want to buy agricultural land, plantation property, or farmhouse? If yes, you are not eligible. Then ask, are you an NRI or OCI card holder? If no, not eligible. So now OCI card holder is also must. Like nowadays, if there is a non-resident and he's not holding OCI card, then also he's not eligible. So you can advise your clients who are NRI, Baba, you have OCI card? You can know, then buy it. It will be useful in future, if you want to buy any property, right? So these are the 3 questions you can definitely ask your client. Now I have just, going to take up one case study, and the facts of the case are like this. There is one Mr. Sukhvinder. He lives in India for past so many years, and he's an agriculturist. He's owning, hundreds of acres of land as agriculture land. He's owning various commercial properties. He's also owning residential bungalows. So that is what Sukhvinder, and his son Balbir lives in Canada for past several years. And he is recently, married to a citizen of Canada, right? Sandra. And they have got 1-year child, Amandeep. So these are the facts of the case, right? So again, so this is a case of change of residential status. Somebody becomes non-resident, and then there are certain things which to be taken care. All right. So as I said, Sukhvinder was born and brought up in Amritsar. He is an agriculturist. He has got 100 acres of agriculture land and 5 farmhouses. He is also owning a huge residential bungalow and several commercial shops in India. And the few of the shops are rented, and he is fetching good rent. Sukhvinder has negotiated a deal to buy 10 acres of agriculture land in Jalandhar, and he has given a token amount as well. Now Sukhvinder would like to spend his balanced life with his son Balbir, who is living in Canada. He decided to migrate to Canada. He has obtained necessary visa, and he is living for Canada on 15th June 2021. Now he has come to you and he has approached you for some advice. So first question is asking, before leaving India, whether he should do anything about his property in India. Can he hold these properties and continue to earn rent and reinvest the money in other assets? Once he starts living with his son in Canada, can he remit money from India? And if yes, how much? And third part is, he has already given a token for a proposed deal to buy 10 acres agriculture land and given power of attorney to his nephew to complete the registration in the month of July 21. Any issue about it? So these are the questions of a person who is going to become a non-resident. Yeah. So, sorry, this is a section 6.5. So section 6.5, we have read earlier that when a person becomes non-resident, whatever property he is owning in India, he can continue to hold, he can sell, he can transfer, whatever income he earns, he can reinvest. So no issue, that is being protected. Okay. Then second thing, once he becomes a non-resident, and if he wants to remit any money outside India, then there is a scheme available for NRI. That is 1 million per year. Sukhvinder can take away money outside India under automatic route. But because he's leaving India and he's going to become a non-resident, because he's going there for his intention is to migrate, right? And under the definitions of Fema, the moment you leave India, either for employment or for doing business or for something with the intention, with the intention not a short-term visit, then he becomes the resident, non-resident the moment he leaves India on that day. So he is leaving, say, on 15th June, he is becoming non-resident. And once he becomes a non-resident, he cannot buy agriculture land, plantation property, or a farmhouse in India. So what advice we can give him? If before leaving, buy it, complete the transaction, complete the share this transaction. Yeah, somebody has raised hand. Shall we allow them to ask question? Or
it seems they have raised a hand by mistake. It is there since long.
Okay. All right. So this
If
Yeah,
they've got
got
any
it.
question, request them to put in a Q&A box, please.
Sure, sure. All right. So this case study is very clear. Everybody, I believe, at least, I cannot ask the participant in general, but the panelist, like, you can give a, nodding that yes, this question,
Yeah,
yeah,
it's going well.
Yes.
yeah, yeah. Thank you, thank you. So this is very simple, yeah, and we got the answer. Now, case study number 2. Okay, read very carefully with me. So Balbir is living in Canada for past 20 years, and now he's a citizen of Canada. He acquired the citizenship of Canada and running a food business there. Last year in the month of September 2019, Balbir got married to a local Canadian citizen named Sandra. Now the couple have a son named Abandip, aged 1 year. Now there are certain facts. The facts are like this. In the year 2010, Balbir bought 3 residential houses in India for a consideration of USD 1 lakh each, and bought 3 shops in India, right? Sorry. And yeah, 3 shops in India at a consideration of 1 lakh each. For residential houses, he took a housing loan in India and paid the installment through inward remittance from Canada. For buying shops, he remitted money from Canada. So as of now, he wants to sell all these properties, and he is fetching $2 lakh for each of the properties. Now he intends to remit money back to Canada. So we need to advise them how much money he can, take away, considering the present provisions under Fema. Then Sukhvinder, who is Sukhvinder like his father, okay? Sukhvinder, who is also an NRI and father of Balbir, he intends to gift agriculture land to his son, Balbir, okay? And a residential house to his grandson, Amandip, right? So these are the 2 things he proposed to do. He wants to gift agriculture land to his son Balbir, now who is also NRI as of now, and a residential house to his grandson Amandip. Okay. Now Sukhvinder has made his will, and he has bequeathed all his properties in India, which includes the agriculture land, farmhouse, as well as to his son. So he has bequeathed everything to his son Balbir. Okay. And Balbir intends to buy a house in India. Balbir, now the son, like Balbir. Balbir intends to buy a house in India jointly with his wife Sandra. Now these are the facts of the case, and I'm sure whatever legal provisions we have just gone through, many of you may be able to answer many of these questions, right? I'm sure for that. Let's go through one by one. So Sukhvinder has left India on 15th June, and he is an NRI because the definition of NRI, because he's still a citizen of India, and he has become a non-resident, so he's an NRI, right? And in case of Balbir, we presume that he's holding OCI card, right? We presume that way. So we have to ensure, if he's our client, we need to ensure, Baba, you are holding OCI card. We say, yes, I am holding OCI card. Fine. So with these assumptions, let's go ahead. So I have made this presentation. Okay. So nature of the property is like shop 1, shop 2, shop 3, residential house 1, residential house 2, residential house 3. So these are the 6 properties. The cost is 1 lakh, and consideration is 2 lakhs each. So total 12 lakhs. Now, how much one can repatriate? So there is a rule 29. Okay, the rule 29 says that in case of an NRI and OCI, if the original investment is made from money remitted from abroad to India, or the house or some loan is taken, but the repayment of loan happens by remittance from outside India, then in that case, the NRI or OCI card holder can take away the full sales consideration outside India, whatever it may be. Okay, full sales consideration. So in our case, in case of shop 1, shop 2, shop 3, he can take away full sales consideration. But in case of residential house, I don't know why, but there is a restriction that they can take away consideration of 2 residential house. right? And lifetime, like in a lifetime, suppose Balbir has acquired in this case 3 houses, right? And he has remitted money from abroad. And at the time of remittance, like you advise him, okay, you sold 3 houses, okay, fine, but Mr. Balbir, you can take away only 4 lakhs for these houses. For 2 lakhs, you cannot take away under this scheme. Then what is a possible other route? Then you will have to advise him, okay, but you can take away balance $2 lakh under US dollar 1 million scheme. Yeah. So point here is that in case of there is a difference between commercial property, and you can see for acquiring, you can acquire as many properties as you want. Yeah. Only thing that you should not be really doing business in immovable property. Like you cannot just buy and sell. That is anyway prohibited in the otherwise in a real estate business is also prohibited. Yeah. So in case of remittance, this I'm sure you all would have understood. It's clear. Okay. So next. Yeah. So what is the question? Yeah. What's it? So what are the rule 24B says an NRI, an OCI may acquire any immovable property in India other than agriculture land, farmhouse or property by way of gift from a person resident in India, from an NRI or from OCI, who in any case is a relative as defined in clause 77 of section 2 of the Companies Act 2013. Okay. So there is an NRI, Balbir, and the father wants to gift him agriculture land because he is the only son, right? So okay, I will give you gift. He cannot do it. Agriculture land cannot be gifted, okay? Even though to his own son or very close relative. Yeah. So other than agriculture land, suppose he wants to gift his shop, right? So he can gift, no issue, but he can give provided he fits in the definition of a relative as defined in section 77 of this 2 of the Companies Act. Now I have taken up one case study for this relative also. That time we will again touch base about the definitions of relative, and we will see that how the definition of relative is contracted, like you can say. Earlier the definition of relative was very vast under Companies Act 1956. Now the definition is become narrower, okay, and then there are certain issues around that. Okay, so Sukhvinder cannot gift agriculture land to his NRI son, and he cannot gift a residential house to his grandson Amandeep. Here only he cannot gift a residential house to his grandson Amandeep, as grandson is not included in the definition of term relative. Just imagine how important it is to refer to the term relative. Okay, so grandson is not covered in the definition of relative. So be careful when such issues arises. Yeah, right. So this is a case study. Yeah, what is this? Answer to, just a minute.
Kirit bhai, you are on a mute, please. Kirit bhai, you are on a mute.
I'm sorry. I adjusting. Okay. So inheritance, no issue. Sukhvinder can make a will, and he can, in the will, he can write, on my demise, all my agriculture land, farmhouse, whatever will go to my son, right? Provided he is an NRI or OCI card holder. Right? Sukhvinder cannot simply, make some foreign citizen or foreign origin. Yeah, that person cannot acquire even by inheritance. Only NRI and OCI card holder can inherit property from resident or non-resident, right? So very clear. In case of agriculture land, farmhouse and plantation property, gifting is not permitted, but the same things can be inherited. Okay. Yeah. So I hope that this case study is also clear to everybody. All right. Now let's go to, yeah. So there was one more case study, I believe. Answer to case number 2. Just a minute, there's something I have to manage here. Yeah. So Balbir wants to buy a house in India jointly with his wife, Sandra. Now, if you read the provisions of Rule 25, it says a person resident outside India, not being an NRI or OCI, okay, who is a spouse of an NRI or an OCI may acquire one immovable property, okay, other than agriculture land, farmhouse or plantation property jointly with his or her NRI or OCI spouse. Then there are certain conditions like consideration must come from India. Consideration must come by inward remittance or from NRE, NRO account. Okay. So, and there is one proviso also, provided that the marriage has been registered and substituted for a continuous period of not less than 2 years. मतलब 2 साल तक marriage टिका होना चाहिए, right? And it is registered. And the spouse भी 11 country की citizen नहीं होनी चाहिए, अगर होना या कोई भी होना या होनी नहीं चाहिए. So that is a condition. So in our case, Balbir has just married last year in the 2019, September 2019, और अभी तक 2 साल खत्म हुए नहीं है. So they will have to wait. Okay. So this is about acquiring property jointly with a spouse. All right. And spouse need not be holding OCI card, okay? Because here I don't think anywhere it is written. It is just saying the spouse, yeah, of an NRI or OCI card who is registered for 2 years. That's all. There is no precondition like she has to apply for OCI card, to my knowledge. Yeah. Though to have OCI card, also the conditions are the same of the 2 years marriage subsistence. Okay. All right. So let's go to next. Yeah. So there are certain provisions about transfer of the property. Yeah. So NRI and OCI, say Mr. Sukhvinder and Balbir, can transfer any immovable property in India, including 3 prohibited properties, to a person resident in India. If Sukhvinder or Balbir wants to sell their agriculture land to any one of us, like we are a resident of India, then no problem. Even suppose we are agriculturists, we can buy, no issue. NRI and OCI can transfer any immovable property other than agricultural land, farmhouse or plantation to NRI and OCI. So in case of NRI, transferee being NRI and OCI, there is restrictions. These 3 restricted property cannot be transferred. And transfer includes gift also, sale also, right? So that is a definition of transfer. All right. Now case study number 3. Okay. So Joginder is a friend of Balbir, who is a resident of Canada. So there is a neighbor named Joginder, and Joginder is owning various properties in Amritsar, and he's in need of money in Canada. So he approached Balbir and told him that I would like, please buy my one bungalow in India and give me money in Canada. Advise him, can you do it? This happens many times, like, you know, 2 NRI friends living together and they say, we don't want to do transactions in India. He's my neighbor. I will give away him whatever money is due to him there only. So this is, I heard this type of cases coming to me. So any NRI or OCI cardholder have to bring money in India. Yeah. So consideration has to be paid out of inward remittance or fund held in any non-resident account, can be NRO, Nri, FCNR account. Okay. And provided further that no payment for any transfer of immovable property shall be made either by traveler's check, any foreign currency notes, or by any other mode other than those specifically permitted. Yeah. So these are very clear, simple. I'm sure you all must have understood. All right. So these are everything about acquiring property by NRI and overseas citizen of India. Now we are touching upon acquisition of immovable property for carrying out permitted activity other than NRIP, or like for a business purpose. So in case of a branch, or a project office other than license office may acquire any immovable property in India which is necessary for or incidental to carrying on such activity. So in case of a license office, only what is permitted is to lease out a property for a term not more than 5 years at a time. So that is a license office can acquire only rented premises. But in case of a project office or a branch, they can acquire, they can buy this property, provided that office premises is incidental to carrying on their business activity. Yeah. So this is something about for these activities. Then there are foreign embassies, diplomats, and consulate general. They can also buy other than these 3 restricted properties. They can buy under automatic route. Then there is something called acquisitions by long-term visa holder. So a person who is a citizen of Afghanistan, Bangladesh, Pakistan, belonging to minority communities in those countries. Yeah, and minority communities are like someone in Pakistan, suppose Hindu, Sikh, Buddhist, Jains, Parsis, and Christian. He is migrated from Pakistan to India and who is residing in India for a long period, and the government has given them long-term visa. Then such type of people can buy one residential property in India and one commercial property for his self-employment, right? And there are various terms and conditions to be fulfilled. I'm not going into that. Okay. Yeah. So with this my presentation is over, and if there are any questions, I will be happy to take. I believe I completed in a very short time, but let it be. The topic is very small.
Yeah, Kirit, thank you. Can you take up some questions which is there? Can you go through it, or shall I read it?
No. I will go. Okay.
Yeah, please.
So one question is that NRI unable to come to India due to COVID, but he want to sell immovable property immediately in Mumbai due to medical requirement. There is no close relative who can be given power of attorney to execute agreement. What are the options available to him? So now these are actually not what you can say Fema question as such, because he is not able to come to India, yeah, due to medical, and he has to sell the property. So I also don't know the answer, like how to execute this. Yeah.
Okay,
Any specific reason this question is asked, like? But I'm sure that transactions, lawyer can answer how to execute the sale deed in India. Somebody signing overseas agreement. It's possible, but he can sell. Okay. Now the question is that if there is no will, whether son, daughter who is non-resident or OCI card holder is eligible for agriculture property buy of inheritance. I think yes, they can definitely obtain the succession certificate, and they can definitely own this property. Will is only one way of transferring assets, right? There are other ways also. Yeah. Very well explained. Thank you so much, Sanjay bhai. Can NRI buy immobile property in JNK now? Good questions. I believe if it is a part of India now, then yes, provided the local government permits that. There is no restriction as such. I think questions are over from Q&A section. Let me see in the chat. Anything is there? Yeah. So there are no questions as such. Yeah. So this was like only I have covered only immobile property in India. I have
Please,
not covered.
one more question, which is
Yeah.
posted now.
Can you touch related question by restriction on rent paid to NRI? So, somebody can pay rent to the NRI for sure, but only thing you have to be careful about Section 195. Yeah, people generally we forget about Section 195 because he's a non-resident and you are paying rent. You will have to deduct tax at 30%, not 10%, and it can be paid to them. NRI, no issue. Can NRI take rent proceeds abroad? Yes, the person who is paying the rent can remit money straight outside India, right? He can remit the money as a rent, no issue, provided at that time chartered accountants may be asked to give certificate in 15 CB and 15 CA to be filled by the remitter. Anything else? Yeah.
Yeah.
So I
think.
Yeah.
Yeah, you answer all the questions, Kirit. Well done.
Thank you.
Thanks a lot for covering all the aspects as far as purchase of immovable property in India is covered. I'll request CA Hiren Bhai to propose a well-deserved vote of thanks.
Yes, sir. Thank you. It was a wonderful session by Kirit Bhai, Dedhia. He has covered various concepts in very simple manner. He explained who can invest in India in immovable property as per eligibility norms. In his presentation, he has covered various case studies to explain various mode by which acquisition of property can be made. Kirit Bhai, BCS is thankful to you for sparing your valuable time and knowledge with us. Thank you very much, sir.
Thank you, everybody. Thank you so much.
Thank you very much, Kirit Bhai.
I enjoyed being here. Thank you so much.
Thank you.
Members will join again on the 29th for the third session of the series, last part of the series, Fema series. Thank you very much. Goodbye.
Chalo, thank you so much, all of you. Thank you so much.
Thank you very much.
Bye-bye.
I'm terminating the meeting.